Our next guest says low interest rates and affordability are part of the reason why Canada's housing market is due for a correction. For more, we turn to the Conference Board of Canada's Michael Burt. Michael, good to see you again.
Good to have me, and thank you.
Now, you are saying that there are signs indicating we are due for a correction. What are those signs you're seeing?
Well, actually, pretty much in line with what you're talking about with your previous guest, basically affordability issues. Prices are very high right now relative to incomes. People are able to have been able to afford it due to the low interest rate environment. But when interest rates start to rise, which we expect later in 2016, people are going to have to start to pull back on spending on housing, and there's going to be some adjustments that need to take place in the housing market.
But while you are calling for a correction, I suppose we need to ensure that we're not sort of chicken little about this whole thing. You're not calling for a hard landing for the housing market in this country. You're still predicting a soft landing.
That's right. And really what you have to think about is there's three components when you talk about affordability. So affordability really boils down to how much people pay per month for their mortgage payment. And affordability is a function of the price of the house, basically how much people had to borrow. It's a function of the interest rate they're paying on that mortgage and also their incomes. Okay. And so one of the things that will help to offset the impact of higher interest rates will be that incomes continue to grow over that period of time. The end result is we do think we're going to have a period of prolonged weakness in housing, several years where house prices are basically flat at best, and not a lot of growth in terms of home building activity.
Okay, so I can imagine the markets we're primarily concerned about here when it comes to corrections, Toronto, Vancouver. When it comes to the big smoke, tell me about Toronto specifically. I can imagine, considering we're seeing near double-digit percentage increases in the value of a standard two-story, that would be where you expect the correction, but it's not. You're figuring it's in condos?
Well, the condo markets is where there's more evidence of overbuilding activity going on. We're seeing a fairly large number of unsold units on the market. In the last couple of months, we've seen big increases in the number of starts going on. So there's going to be more units coming on the market over the next 2 or 3 years as those projects come to completion. And you can already see it. I mean, again, you talked about it a little bit earlier in your show, but price appreciation on the condo market is much weaker than it is for those single-family homes. And that's just down to the fact that supply is much more available there relative to single-family homes, and so that's the market where the imbalance is most likely to occur.
So when we talk about a correction, for someone who's looking at that condo they just bought, what percentage decline are you expecting in the value of that condo?
Well, broadly speaking, for Canada as a whole, we have a very modest decline in prices. I think it's about 1%. I mean, obviously, it'll depend on which market you're in, what type of house you're owning. I don't have an exact forecast for condo markets in Toronto, but it's probably in the order of something like less than 5%. We're not talking a huge decline in prices. Really, it's more about 2 or 3 perhaps even longer, 2 or 3 years, perhaps even longer, of essentially no increases in prices.
So if we have a rising interest rate environment, perhaps not this year, and perhaps not until the tail end of next year, I can imagine that not only crimps the demand side to a degree, but this would also impact those putting on a hard hat and putting a hole in the ground.
Well, of course, we've already seen employment, some signs of weakness in employment in terms of wage growth. We do think there's going to be some job losses in the residential construction industry over the next couple of years. One of the things that will help to soften the blow to some extent for home builders, for the residential construction industry, is renovation activity, which we often forget about. That's about half of all consumer spending on investment in their homes comes from renovation and repairs. And so that market, we do expect to see some weaker growth, but it's going to help to soften the blow for residential builders.
So I suppose then the solution, as Roy LePage has been suggesting today, the solution to the high price problem is higher interest rates.
Well, basically, I think we would agree with that in the sense that higher interest rates will lead to more of a normalization in the market. Currently, interest rates are essentially at historic lows. That's obviously not normal, not sustainable. As interest rates rise, the market will move back to a more normal environment, and that's likely going to mean some adjustment in prices relative to income over the forecast period.
I was fascinated by your report pointing out that there's a Canadian dollar implication to this. When we think about the housing market and building construction, I thought that we were using Canadian trees for the wood that goes into the framing of these homes.
Oh, we most certainly are, at least broadly speaking. Obviously, some exotic things like bamboo isn't necessarily coming from Canada, but the thing to remember is even though construction is a domestic industry, some things are imported. Some of the things that builders use, such as their equipment, may be imported. And even if the products are not imported, wood is a great example of that. North American prices for wood tend to be set in U.S. dollars, and so even if the U.S. dollar price isn't changing, the Canadian price has actually risen over the last year or so, given what's been happening with the Canadian dollar.
Michael, we appreciate your insight. Fascinating stuff. Thank you so much.
Thank you. Thanks for having me.
Michael Burt is the director of the Industrial Economic Trends Division of the Conference Board of Canada. He joined us from Ottawa.